That gold dump wasn't fear, it was choreography. And the market just left fingerprints all over the tape. They'll tell you it was profit taking. They'll tell you it was a stronger dollar. They'll tell you it was yields ticking up. And sure, those are the kinds of headlines that can justify a move after the fact. But normal pullbacks don't happen like that. Normal pullbacks don't drop through obvious levels with that kind of speed, in that kind of timing window, and then behave the way this one behaved as soon as it got where it needed to go. Because here's the tell most people missed. The sell-off didn't look like people exiting. It looked like something being built. And once you see that, the whole story changes. Not in a conspiracy way, in a plumbing way, in an incentives way, in a market structure does what it always does when the calendar, liquidity, and derivatives line up way. And that matters right now because what happens next week isn't going to be decided by vibes or by what someone says on TV. It's going to be decided by where positioning sits, where dealer hedging pressure flips, and whether the physical market quietly refuses to validate what the paper market just did. And if you stay with me, I'm going to give you a concrete map. The zones that matter, the signals that confirm the signals that invalidate, and the one metric that will end the debate on whether this was a flush or a setup. Now let's get the obvious out of the way. Gold can drop for perfectly legitimate reasons. Real yields can rise. The dollar can catch a bid. Risk can get repriced. Funds can take profits. But the shape of the move tells you what kind of participants were driving it. And this move had the shape of mechanics, not sentiment. It had the feeling of liquidity thinning, a level breaking, and the market forcing the maximum number of participants to do the same thing at the same time. That's not everyone suddenly got bearish. That's the machine doing what it's designed to do: hunt liquidity, trigger conditional orders, and reset positioning without asking permission. And that's where the real pressure starts. Because the moment you understand that, you stop arguing about whether the news was bad enough. You start asking a more dangerous question. Who needed this move to happen, and what did it allow them to do? Here's how you can tell you're looking at choreography. When price falls and participation rises, that's not the crowd leaving. It's someone stepping in with size. That might sound counterintuitive, so let me make it concrete. If a market drifts lower because buyers simply vanish, you tend to see volume taper and interest fade. But when you get a sharp, clean break lower with heavy turnover, and then the market stabilizes in a very specific zone, what you often saw was not a mass exodus. You saw transfer. Someone was selling aggressively into thin liquidity, knowing exactly where stop orders would be, knowing exactly where systematic players would be forced to react, and knowing exactly where they wanted the other side of the trade to begin. And the next detail is what flips the whole setup. Coordinated doesn't have to mean a meeting. Markets coordinate themselves through incentives, dealers hedge, funds rebalance, risk managers tighten, systematic strategies follow rules. All of those separate actors can end up acting in the same direction at the same time because the plumbing makes it rational. That is why you can get a move that looks organized, even if nobody ever spoke to anybody. Think about it like an evacuation drill. Nobody needs to conspire to exit the building. The alarm goes off, the exit signs light up, and the crowd moves in the same direction because the architecture funnels them there. In markets, the alarm is a level breaking, volatility spiking, and certain hedges going from optional to mandatory. The exit signs are stop clusters and margin triggers. And the architecture is the futures order book and the option surface and the way dealers manage delta and gamma. And that's not the part that matters. The part that matters is timing. Because this week isn't just another week. This is the kind of period where liquidity conditions and calendar effects can turn a normal repositioning into an air pocket. Early year positioning resets are real. New risk budgets come online. Some players put on fresh hedges, others harvest gains and rebalance. And there are windows, thin ones, where a relatively concentrated burst of selling can do a disproportionate amount of damage. You get a weekend gap risk mindset. You get thin liquidity around certain sessions. You get the market leaning on specific strikes and options. You get the kind of environment where a push through one obvious level doesn't just move price. It changes the behavior of the participants who provide liquidity. Because if this one level breaks, the math changes. Here's what that math looks like in plain language. Gold futures are leveraged instruments. A lot of participation is not I love gold participation. It's risk managed participation. It's I need exposure, but I can tolerate a drawdown beyond X participation. It's if volatility rises, I must reduce exposure participation. It's if this support breaks, my model flips participation. And those participants tend to share similar reference points: recent swing lows, round number zones, widely watched moving averages, previous breakout levels. Markets know that. So when price approaches a crowded level, you don't just have discretionary traders watching. You have a minefield of conditional orders sitting there: stops, stop limits, risk-off triggers, CTA models, volatility targeting, and then the game becomes simple. If you can push price through that doorway when the hallway is narrow, the crowd will stampede through on its own. That's how you get the elevator drop. Not because everyone decided simultaneously that gold is worthless, because the market structure turned a small push into a forced reaction. And that's where it gets even more interesting. Because in gold, you have another layer that can amplify that reaction. Options, reflexivity. This is the piece that retail investors hear about, but rarely see described in a way that helps them navigate the next week. So let's do it cleanly. Options have a delta, which is basically how sensitive the option's price is to the underlying move. Dealers who sell options often hedge that delta by buying or selling the underlying. Gamma is how that delta changes as price moves. When dealers are short gamma in a region, hedging becomes pro-cyclical. Price drops, their hedge needs push them to sell more into the drop. Price rises, their hedge needs push them to buy more into the rise. It's like a feedback loop. That doesn't mean options cause every move, but when the market is sitting near big strikes, levels where a lot of open options exist, dealer hedging can turn a dip into a drop and a rally into a rip-your-face-off squeeze. The ugly part is that it happens fast because hedging is not emotional. Hedging is mandatory. And when hedging becomes mandatory, at the same moment stops become mandatory and risk models become mandatory, you get a mechanical cascade that looks like someone pressed a button. And that's exactly why people say it was coordinated. And what they're really sensing is synchronization. The market synchronized participants' behavior. Now, let's stack proof, because one argument is never enough if you actually want trust. Proof point one is the tape signature, the speed, the timing, and the follow-through. Random selling is messy. It doesn't usually have that clean acceleration through an obvious line, and it doesn't usually stabilize in a way that feels like a handoff. When you see a sharp impulse, then a pause right where hedging pressure likely changes, and then a reaction that respects that zone, you're looking at structure. You're looking at a move that found its target, but that's not the part that matters. Proof point two is participation. On a real change in fundamental perception, you often see a broad, multi-session repricing with persistent selling pressure, sellers showing up on every bounce, and a gradual change in the slope of the move. On a mechanical flush, you often see a violent move, then a volatility spike, then a kind of stunned silence where the market either snaps back or grinds while participants reassess. The key is what happens after the dump. Do bounces get instantly smothered, or do they breathe? Do spreads in related markets confirm the panic, or do they hint that this was paper-driven? Because in gold, the difference between paper and physical is not a philosophical debate. It's a set of signals. And if you learn to watch them, you stop being at the mercy of headlines. Proof point three is the convenient cover story, dollar and rates. Yes, gold is sensitive to the dollar. Yes, gold is sensitive to real yields and inflation expectations, but those variables explain wind, not the sail. They can help you understand why the market was vulnerable to a pullback. They don't explain why the move looked like a trapdoor at that particular moment. And the next detail is what flips the whole setup. Markets often use macro headlines as camouflage for microstructure events, not because anyone is hiding. Because narratives always follow price, and the loudest narrative is the one that fits. If yields were up a bit, the headline becomes yields hit gold. If the dollar was firm, the headline becomes strong dollar pressures gold. That doesn't mean it's wrong, it means it's incomplete. The real question is why it moved the way it did, not just why it moved at all. Proof point four is the institutional narrative split. Institutions can be bullish on gold over the year and still expect and even benefit from violent pullbacks. Because pullbacks reset positioning, they shake out leverage, they let big money add exposure without paying the premium that a one-way market demands. If you have ever wondered how a market can be in a longer-term uptrend and still punch you in the teeth on random Tuesdays, this is why. Trend is a signal. Volatility is the weapon, and sophisticated participants know how to use it. Proof point five is the physical versus paper question. The most important question isn't did gold drop? It's did physical loosen or did paper just get slapped? Paper is futures, forwards, options. Financial instruments that are extraordinarily sensitive to leverage and hedging. Physical is actual bars moving through the chain. Refineries, vaults, fabricators, jewelry demand, industrial demand, central bank accumulation, and regional premiums. You don't need to pretend you can see every vault door opening. You just need to know what kinds of signals to watch. Do you see stress in spreads? Do you see unusual premiums? Do you see signs of tightness in deliverable categories versus non-deliverable stock? Do you see regional price behavior that suggests arbitrage is pulling metal? And that's where the real pressure starts, because if physical remains firm while paper gets slammed, the sell-off can be a transfer, not a thesis change. Now let's talk term structure, because this is where the market quietly tells the truth. Gold typically carries. There's a cost to store and finance it. The curve often reflects that. But when you get stress, the relationship between near-term and later delivery can shift. Spreads can widen or behave oddly. Sometimes the market screams tightness in the structure, even while spot is getting punched. Sometimes it screams abundance, even while spot is rallying. That's why I say the price can lie and the spread can tell the truth. And if the curve and spreads don't fully confirm the panic in spot, that's the market telling you the move was positioning, not genuine demand destruction. But that's not the part that matters. The part that matters is deliverability. People throw around inventories like it's one big pile. It isn't. There are categories. There's metal that can be delivered into certain contracts under certain rules, and there's metal that exists but isn't realistically coming to market at a price that matters right now. There are logistics. There are bars of certain specifications. There are vaulting locations. There are time delays. In other words, inventory is not a single number. The only useful question is, can that metal actually be delivered right now where it's needed? If the answer is not easily, then paper selling can create price declines that don't truly solve the underlying physical tightness. And when paper tries to bully physical, physical eventually votes. It might vote immediately with premiums and spreads. It might vote later with delivery behavior, but it votes. And the next detail is what flips the whole setup. Global arbitrage. Gold is global, but it doesn't trade as one unified market. You have major hubs. You have different demand patterns. You have different time zones where liquidity is thicker or thinner. When regional pricing diverges, arbitrage becomes the gravitational force. If one region is paying more for physical, metal wants to move there. If one region's demand is more resilient, it can put a floor under the complex, even while futures are being pushed around. And if you've ever watched gold dump in one session and then feel strangely bid elsewhere, that's not magic. That's global demand and hedging interacting. So when you hear coordinated, you should think synchronized incentives and arbitrage, not cartoon villains. It's more interesting than villains. It's math. And this move isn't emotion. It's math. Now let's address the biggest objection head on, because credibility requires it. What if it really was the top? What if the dump was a genuine change in regime? You don't earn trust by refusing to say that out loud. Sometimes markets turn. Sometimes a breakdown is not a stop run. It's a trend reversal beginning. That's why we need invalidation. We need conditions that, if met, tell you this is not just a flush. And those conditions are not, I feel bearish. They're structural. For example, if gold breaks down through multiple support zones and cannot reclaim them on a bounce, and if the bounce gets aggressively sold in a way that expands, spreads negatively, and confirms with correlated markets, that's different. If the dollar moves into a sustained breakout and real yields grind higher persistently, pressuring the entire complex for weeks, that's different. If physical signals soften, premiums fade, tightness eases, demand appears to step back, that's different. The point is not to be dramatic. The point is to be prepared, because price can whip around violently even if your thesis is correct. That's not a disclaimer. That's the game. Volatility will try to steal your position. It will try to make you sell the bottom and chase the top, and that's where the real pressure starts. So here's the map for right now, and I'm going to keep it practical. First, stop treating every candle as a verdict. Separate trend signal from noise. The trend signal is whether gold can hold the lower part of its recent range and reclaim key zones on a bounce, especially zones that were previously support and now act as resistance. Noise is the intraday chaos, the headline whiplash, the "it's over" tweets. Second, watch the zones that matter because of mechanics, not because they look pretty on a chart. The most important zone is the first major breakdown area, the area where the market fell through and accelerated. If gold can reclaim that zone and hold it for more than a moment, it suggests the dump completed its mechanical job, and the market is now forcing sellers to reassess. If gold rallies into that zone and gets rejected hard, it suggests the dump created a new ceiling and sellers remain structurally in control. Third, watch whether dips are being bought in a way that changes the character of the tape. Do you see shallow pullbacks, quick bids, and reduced follow-through on downside attempts? Or do you see every bounce sold with liquidity thinning again? Because if liquidity thins again, the math changes. Fourth, watch participation. You don't need to obsess over every data point. Just look for the story. Is participation increasing as price stabilizes? That can be a sign of new positions getting built rather than old ones getting liquidated. Is participation decreasing as price drifts? That can suggest exhaustion. Fifth, watch the options magnet behavior. When markets hover around certain zones, it's often because hedging flows are pinning price, especially near expiry windows or when large strikes are in play. You don't need to know the exact strike. You need to recognize the behavior. Price repeatedly returns to a zone, volatility behaves strangely, and attempts to escape are either violently rejected or violently extended. That tells you hedging is part of the story. And the next detail is what flips the whole setup: scenario planning. You need two scenarios, always. Because one scenario thinking is how people get emotionally manipulated. Scenario one is the controlled pullback and retest. In this scenario, gold stabilizes, grinds, and then retests the breakdown area from below or above. It might chop, it might frustrate, it might look boring. But if it holds the lows and reclaims key zones gradually, that's a market digesting a flush. In that world, the dump was a reset, not a reversal. Scenario two is the continuation squeeze in the other direction, or a continuation breakdown depending on what the market does next. A squeeze scenario can happen if the dump attracted new shorts, and then price snaps back through the breakdown area, forcing those shorts to cover while dealers are forced to buy hedges as price rises. That can create gap risk to the upside, especially in thin liquidity windows. The breakdown continuation scenario happens if gold fails to reclaim the breakdown zone, bounces weakly, and then breaks the low again with renewed follow-through. In that world, the dump wasn't just a flush, it was the start of a deeper repositioning. Both are possible. The job is not to predict. The job is to watch what confirms each. So what confirms scenario one? Stabilization that refuses to break the lows again, bounces that hold better than they should, and a reclaim of the breakdown zone that sticks. What confirms scenario two? The squeeze. A fast reclaim, rising urgency in the tape. An evidence that sellers are getting trapped, meaning rallies don't get sold immediately and dips are shallow. What confirms the bearish continuation? Weak bounces, repeated failures at prior support turned resistance, and a fresh low with heavy follow-through that doesn't snap back. And that's where the real pressure starts, because your behavior must change depending on which scenario is unfolding. If you treat a controlled retest like an apocalypse, you sell the bottom. If you treat a breakdown continuation like a dip buying opportunity without a plan, you become the liquidity. Now, let's talk about the coordination question directly, because this title isn't timid, and it shouldn't be. Was the gold dump coordinated? In the sense that multiple forces align to produce a high probability flush, yes. In the sense of someone snapped their fingers and pressed a red button, the market doesn't need that. The market coordinates through structure. Here are the forces that can align without any secret meeting. 1. Systematic selling triggers. When certain trend signals flip, CTAs and similar strategies reduce exposure. 2. Volatility targeting. When volatility rises, many funds mechanically reduce risk. They sell. 3. Dealer hedging. When the options book is positioned a certain way, hedging is forced and pro-cyclical. 4. Stop clusters. When price hits obvious levels, stops become market sells, and market sells create slippage, and slippage triggers more stops. 5. Margin. When price drops fast, margin requirements can effectively rise, and leverage participants become forced sellers. 6. Liquidity. In certain windows, order book depth is thin, meaning a smaller amount of aggressive selling can move price much more. Put those together, and you get something that looks coordinated because it is coordinated by design. It's like dominoes lined up by risk rules. You don't need someone to push every domino. You just need one push at the right domino. And that's not the part that matters. The part that matters is what the push accomplishes. A flush accomplishes 3 things. It resets leverage. It transfers exposure from weak hands to strong hands. And it rewrites the options and futures positioning so the next move becomes easier. That is why you often see the most violent sell-offs occur not at the end of a bear market, but inside bull markets. Because the market needs these pressure releases to keep going. Now, you may be thinking, okay, but what's the hidden detail you promised? Here it is, and it's underappreciated because people stare at spot and ignore the mechanisms around it. The hidden detail is that this kind of dump is often less about changing the narrative and more about changing the hedging regime. In other words, the dump can be a way to move the market from one zone of dealer gamma exposure into another, from one zone of systematic positioning into another, from one zone where shorts are uncomfortable into another where longs are vulnerable. It's like moving pieces on a chessboard. Not because someone is manipulating in a movie sense, but because liquidity and hedging pressures are different at different prices. There are prices where dealers are forced buyers. There are prices where they become forced sellers. There are prices where stops cluster. There are prices where call walls and put walls pin. There are prices where margin pain is maximal. If you can move price from a zone where the market resists going down into a zone where the market accelerates going down, you can get a lot done quickly. You can trigger the cascade. You can harvest liquidity. You can buy back hedges cheaper. You can restructure options. You can reset exposure. That's the hidden mechanism mainstream misses. The sell-off wasn't just selling. It was a repositioning event. And that's where the real pressure starts. Because repositioning events are often followed by violent reversals or violent continuation. Either way, volatility stays elevated. So let's talk about how volatility will try to manipulate you. Because if you're in this space, metals, commodities, macro, you already know the institutions don't need to lie to beat you. They just need you to react. Here's how the emotional manipulation works in practice. First, you get the shock candle. It triggers panic. Your brain screams, "Get out." Then you get a bounce. It triggers hope. Your brain screams, "It's safe." Then you get another downdraft. It triggers despair. Your brain screams, "It's over." Then, sometimes you get a face-ripping reversal that leaves you watching from the sidelines. This is not random. This is how volatility extracts money from people who don't have a plan. The antidote is not bravery. The antidote is structure. Decide your time horizon. Decide your risk. Decide what invalidates your thesis. Decide what confirms it. And then, when the market tries to hijack your emotions, you fall back on the plan. If you're a long-term holder, you treat violent flushes as information, not as an emergency. If you're a short-term trader, you size so that you can survive the whip. Because price can whip around violently even if the thesis is correct. It can also whip around violently if the thesis is wrong. And that's why risk management is not optional, it's the entry fee. Now, what should you watch next week specifically? Watch the reaction to macro prints and policy messaging, but not the headline. Watch the market's response. Does gold sell off on bad news and fail to bounce? That's weakness. Does gold absorb bad news and hold levels? That's strength. Watch the dollar, yes, but watch whether gold decouples. Decoupling is a tell that something structural is happening. Watch real yields, but watch whether gold ignores them at key levels. Watch related markets. Silver's behavior can sometimes reveal speculative appetite and stress. Watch mining equities if you follow them, but remember they carry their own equity market risk. Watch spreads and the curve if you can. Even a simple observation helps. Is the move being confirmed by the structure, or is spot doing something that looks isolated? Watch ETF flow narratives if you follow them, but understand that flows often lag price and are not always the driver. Watch the on-the-ground symptoms if you have access, premiums, availability, regional pricing chatter, because physical sometimes whispers before spot screams. But the next detail is what flips the whole setup, the key levels. I'm not going to give you fake precision. I'm going to give you zones and what they mean. Zone 1 is the breakdown zone, the area the market sliced through when it accelerated. If price reclaims that zone and holds it, it suggests the mechanical selling has exhausted and the market is forcing sellers to cover or step back. Zone 2 is the lower stabilization zone, the area where the move finally paused. If that zone breaks cleanly again with follow-through, you're not in a simple retest anymore. You're in continuation. Zone 3 is the first major bounce ceiling, where the first strong bounce meets selling. If that ceiling is taken out with urgency, your squeeze scenario becomes much more likely.